The Gold Bar Benchmark, Measuring the Real Cost of Homeownership Across Nations. Introduction. Rethinking homeownership in hard money terms. A house is the largest purchase most people will ever make, and also the most misunderstood. In a world of fiat currencies, government interventions, and shifting interest rates, the true cost of housing is often buried beneath layers of inflation, monetary distortion, and artificially low debt servicing. Most people ask, can I afford the monthly payment? But the better question is, what is this home actually worth in real terms? This exposition introduces a global benchmark that reframes housing prices through a harder, more stable lens, the 100-ounce gold bar. By using gold as a universal unit of account and comparing how many bars it takes to purchase a median home in various countries, we bypass local currency fluctuations and expose the underlying economic truths. When layered with each nation's long-term borrowing rates, 10 and 30-year yields, we arrive at a clearer picture. Not just what homes cost, but how access to them is financed, and whether that access is truly sustainable. Section 2. The Gold Bar Benchmark. The Gold Bar Benchmark defined. Gold is not just a commodity. It's a time-tested store of value across civilizations. It resists debasement, transcends borders, and cannot be printed into existence. By standardizing housing prices in 100-ounce increments, what we'll call the Gold Bar Benchmark, we can evaluate real estate not by its fiat price tag, but by how much real money it requires. Formula in plain English: take the median home price in local currency and divide it by 100 times the price of gold per ounce, also in local currency. This gives you a unitless number: how many 100-ounce gold bars are needed to buy the median single-family home in any given country. A ratio of 1 means housing is priced in parity with 1 gold bar. That's 100 ounces of gold. A ratio greater than 1 means housing is relatively expensive in gold terms. A ratio less than 1 means housing is relatively cheap in gold terms. This approach helps us escape the illusion that a house is worth more just because the currency it's priced in has been devalued. Section 3. Case Studies. Gold-to-house ratios across nations. We now examine a selection of countries using the Gold Bar Benchmark, measuring their median home prices in units of 100 ounces of gold across key time periods. For each nation, the date range spans from 1970 to 2025, with a focus on stability, volatility, and macroeconomic alignment. Switzerland, 2025 ratio, approximately 1.25 gold bars. Historical range, 0.8 to 2.3 gold bars. Insight, known for monetary conservatism and financial stability, Switzerland's gold-to-house ratio has remained remarkably consistent over time. Home prices track gold reasonably well with modest volatility. United States, 2025 ratio, approximately 1.25 gold bars. Historical range, 0.8 to 6.2 gold bars. Insight, the United States exhibits some of the widest swings in the gold-to-house ratio. In the early 1980s, gold prices spiked relative to home values. In the early 2000s, housing prices soared while gold lagged, sending the ratio above 6 bars. In recent years, gold has caught up. The current ratio of 1.25 suggests nominal home values are being inflated by currency debasement rather than wage growth. Japan, 2025 ratio, approximately 0.30 gold bars. Historical range, 0.2 to 0.4 gold bars. Insight, Japan shows the most stability in gold terms. Despite housing booms and busts, gold price appreciation has largely offset home price drift. Ultra-low interest rates and deflationary forces keep the ratio anchored. China, 2025 ratio, approximately 0.76 gold bars. Historical range, 0.1 to 1.8 gold bars. Insight, China's housing market reflects a dramatic shift from state-owned dwellings to speculative urban towers. The current ratio of 0.76 means urban homes are cheaper than gold in real terms, driven by high gold demand and cooling real estate prices. Volatility has been significant, from a low of 0.1 bars during the 1980 gold spike to nearly 1.8 bars around the year 2000. In 2024 alone, Chinese citizens purchased over 336 tons of physical gold, signaling cultural preference for gold as a store of value amid property sector uncertainty. Germany, 2025 ratio, approximately 0.44 gold bars. Historical range, zero point 0.4 to 2.2 gold bars. Insight, Germany shows moderate volatility with ratio spikes during reunification and Eurozone transitions. In recent years, gold has outpaced housing prices, pushing the ratio lower. Canada, 2025 ratio, approximately 0.47 gold bars. Historical range, 0.4 to 1.7 gold bars. Insight, Canada's ratio peaked during the early 2000s housing boom, then corrected. In the 2020s, rising gold prices have helped offset inflated real estate values. Australia, 2025 ratio, approximately 0.26 gold bars. Historical range, 0.2 to 1.5 gold bars. Insight, despite massive housing price increases, Australia's ratio has stayed surprisingly stable. This reflects commodity-driven currency strength and strong domestic demand for physical gold. Section 4, the cost of debt, yield curves, and long-term burden. The price of a home is only half the equation. The other half is how people pay for it, and that hinges on the cost of debt. Most homebuyers don't purchase houses in cash or gold. They finance them through long-term loans, often stretching over 20 to 30 years. That financing is fundamentally linked to sovereign bond yields, particularly the 10-year and 30-year government bonds, which serve as benchmarks for mortgage rates. In fiat terms, a house may seem affordable if interest rates are low, even if the actual price has ballooned. But viewed through the gold bar benchmark, this creates a disconnect. The monthly payment shrinks while the principal price inflates, making it feel cheaper, but only because time is being monetized more aggressively. Real interest rates as a housing distortion tool. In the U.S., for example, 2000s, home prices soared while 30-year mortgage rates fell from 8% to 4%. Gold remained undervalued until 2008, causing the gold-to-house ratio to rise steadily. 2020 to 2021, ultra-low rates, 2.7% mortgages, caused housing to explode in price, even as gold held steady, leading to a rising gold bar ratio, not because homes were worth more in real terms, but because the cost of borrowing money was artificially suppressed. In contrast, Japan has operated under ultra-low to negative rates for decades, yet its gold-to-house ratio remains low and stable, not because homes are cheap in yen, but because both gold and property have moved in tandem under Japan's unique deflationary environment. Germany and Switzerland, with more conservative monetary policy, display tighter coupling between gold prices and home values, though recent global yield suppression has stretched that equilibrium. Now on screen, we have a global snapshot of 10-year government bond yields, approximate for the year 2025, along with mortgage lending cultures and key macro insights for each country. Let's go row by row. First, the United States. The 10-year bond yield sits between 4.5 and 5%. The mortgage culture is built around 30-year fixed-rate loans, which are common and widely used. Insight, rising long-term yields are exposing overvaluation in housing prices, especially in markets that depended on ultra-low rates. Next, Japan. The 10-year yield is just 0.7%, still incredibly low. Fixed-rate mortgages exist, but they are rare. Most mortgages are variable or short-term. Insight, Japan's structurally low-yield environment supports ratio stability. Home prices barely move, and gold maintains its footing. Now, Germany. The 10-year bond yields around 2.6%. Mortgage terms are generally shorter, with less of a culture around long-term fixed rates. Insight, Germany benefits from low debt costs, keeping home price pressure moderate, though certain metro areas remain frothy. Moving on to Switzerland. The 10-year yield is about 1.2%. Lending practices are highly conservative, with tight credit standards and strong borrower scrutiny. Insight, the low and steady yield floor, combined with conservative lending, contributes to long-term gold-to-house ratio stability. Next is Canada. The 10-year bond yields around 3.6%. Mortgage culture includes high loan-to-value ratios, and short-term refinancing is common. Insight, these dynamics make Canada more boom and bust prone, as borrowers are more exposed to short-term rate shocks. And finally, Australia. The 10-year yield is about 4.2%. The market is heavily exposed to variable rate mortgages, meaning borrowing costs shift with policy changes. Insight: this leads to increased leverage pressure during rising rate cycles, which can trigger sudden shifts in housing affordability. In all cases, the gold bar benchmark plus sovereign yield gives a clearer picture of whether housing is being propped up by cheap credit or holds real lasting value. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5. Interpreting the ratios: inflation, volatility, and truth. At first glance, a gold-to-house ratio might seem like a simple curiosity, just another quirky valuation metric. But when we track the ratio over time, across multiple countries, and layer in long-term bond yields, it becomes a diagnostic tool, a way of measuring how monetary systems are behaving beneath the surface. When the ratio rises, a rising gold bar benchmark, i.e., it takes more gold bars to buy a house, can mean home prices are rising faster than gold, often due to housing bubbles. Gold is undervalued relative to fiat, e.g., early 2000s. Debt is cheap, fueling speculative real estate demand. This often reflects asset inflation without real wealth creation. In such periods, housing may feel more valuable in fiat terms, but is actually drifting further from its anchor in real money. When the ratio falls, a falling ratio, i.e., fewer gold bars needed to buy a home, can mean gold is rising sharply, often due to inflation fears or fiat debasement. Home prices are stagnant or falling, e.g., post-crisis corrections. Borrowing becomes more expensive or harder to access. This typically signals a market reversion toward monetary reality as gold asserts its store of value function while fiat or credit-driven housing growth stalls. Cyclical insights from the ratio. Let's examine key historical episodes. 1980 U.S., ratio dropped to 1.04 bars. Gold spiked due to inflation and monetary instability, while housing was relatively subdued, a clear warning signal for fiat distress. 2000 U.S., Canada, Australia, ratio peaked at 4 to 6 bars. Gold was undervalued, homes overvalued, a perfect storm for mean reversion. 2025, Japan, Australia, ratios under 0.3 bars. Gold strength and housing softness combine, real affordability in hard money terms. Switzerland, ratio rarely strays too far from 1. This reflects a currency and housing market aligned with long-term value preservation. What the ratio reveals. The gold bar benchmark is not just about comparing home prices to gold. It's about revealing what fiat currency hides. Is the asset stable in real terms or propped up by leverage? Has housing become a financialized product or a store of shelter? Is a society rewarding savers or forcing debt-fueled speculation? By asking not how many dollars, but how many ounces, we reintroduce accountability, truth, and intertemporal fairness into one of the most manipulated markets in the modern economy. Section 6. Toward a Housing Truth Index. If gold-to-house ratios reveal the real value of shelter and debt yields expose the real cost of accessing it, then the logical next step is to combine these signals into a composite framework, a standardized lens to assess housing markets across nations over time. We call this framework the Housing Truth Index, HTI. What is the Housing Truth Index? The Housing Truth Index, or HTI, is a composite score that reflects real asset valuation, measured by the gold bar ratio, debt access cost, measured by 10-year and 30-year sovereign bond yields, monetary signal, calculated as real interest rates, which equal nominal yield minus inflation, housing stability signal, measured by the volatility of the gold-to-house ratio over time. By blending these elements, the HTI creates a scoring matrix for comparing nations based on the truthfulness of their housing markets. In other words, how well home prices reflect real value, rather than manipulated liquidity or suppressed interest rates. Here is the proposed HTI scoring model shown on the screen. Table title: Proposed Housing Truth Index Scoring Model, 0 to 100 scale. Let's walk through it, row by row. Component 1, gold-to-house ratio weight, 40%. Scoring description: the closer the ratio is to 1.0, the better. We penalize for significant deviation, meaning if a home costs way more or way less than 1 gold bar, something's off. Component 2, average 10-year and 30-year sovereign yield weight, 20%. Scoring description: Lower yields suggest artificial monetary support. We reward higher, market-driven yields that signal authentic borrowing costs. Component 3, real rate, which we define as sovereign yield minus consumer price inflation weight, 20% scoring description. A negative real rate means inflation is masking the true cost of debt. We reward positive or near zero real rates. Component 4, ratio volatility measured by standard deviation. Weight 20%. The less volatile the gold to house ratio over time, the more integrity the market has. Lower is better. Now let's see how this plays out across nations in our comparison set. Table title, Housing Truth Index, cross-national comparison. We'll go row by row and read the columns clearly. First, Japan gold bar ratio in 2025, approximately 0.3, range from 1970 to 2025, 0.2 to 0.4. Average sovereign yield, approximately 0.7%. Estimated real rate, around 0.1%. Ratio volatility, very low. Housing truth score, 88. Interpretation, Japan tops the list. Despite decades of economic stagnation, its housing market tracks gold remarkably well, and yields remain stable. Next, Switzerland. Gold bar ratio, approximately 1.25, range 1.1 to 1.4, sovereign yield, around 1.2%, real rate, roughly 0.8%, volatility, low. Score 82. Interpretation, a strong contender. Conservative lending and currency discipline create a consistent housing truth profile. Third, China. Gold bar ratio, approximately 0.76, range 0.08 to 1.79. Sovereign yield, roughly 2.6%. Estimated real rate, 1.5%. Volatility, moderate. Score, 74. Interpretation, China has wide historical swings but currently sits below parity. Strong cultural demand for gold balances its housing market risks. Next, Australia gold bar ratio, approximately 0.26, range 0.17 to 0.57, sovereign yield around 4.2%, real rate roughly 2.2%, volatility moderate. Score, 76. Interpretation, despite price booms, Australia's gold-to-house ratio remains fairly consistent. It's held up by a strong currency and vibrant gold trade. Germany, gold bar ratio, about 0.44, range 0.38 to 0.92, sovereign yield, around 2.6%, real rate 1.0%, volatility, moderate, 72. Interpretation, Germany performs solidly, but Eurozone dynamics and reunification-era shocks have introduced some turbulence. Canada, gold bar ratio, roughly 0.47, range 0.4 to 1.7, sovereign yield around 3.6%, real rate estimated at 1.2%, volatility high, score 66. Interpretation, Canada's short-term debt cycles and frothy property markets increase volatility. Ratio swings are harder to contain. And finally, the United States, gold bar ratio, approximately 1.25, range 0.84 to 6.2, sovereign yield around 4.5%, real rate roughly 1.0%, volatility high. Score 62. Interpretation, the U.S. market appears deeply misaligned. While long-term yields are rising, years of suppressed rates and speculative growth have driven extreme volatility, especially post-2008. Now here's the key takeaway. The higher the score, the more honest the housing market. A high HTI score implies a nation whose housing market remains grounded in reality, with prices that track real money, borrowing costs that reflect real conditions, and a stable relationship between shelter and savings. By contrast, a low score signals distortion, inflated prices, hidden debt burdens, and volatility disguised by fiat expansion. In an era of monetary manipulation, the Housing Truth Index offers a new compass to navigate through the fog of nominal illusions and find real value, real shelter, and real sovereignty. Visual dashboard, future vision. Imagine a real-time, interactive dashboard showing current gold bar ratios for major cities and nations, local mortgage rates versus bond yields, inflation-adjusted HTI scores and trend direction, red, yellow, green indicators for over-under valuation. This would give policymakers, investors, and individuals a truth layer view of global housing markets, much like credit ratings for sovereign bonds, but grounded in hard value and intertemporal honesty. Section 7. Implications for policy, investors, and individuals. The Gold Bar Benchmark and the Housing Truth Index, HTI, don't just offer insight, they reveal misalignments between value, access, and trust across housing systems. These insights carry important implications for governments, investors, and ordinary citizens alike. For policymakers, time to rethink housing affordability. Most housing policy is based on fiat illusions, managing monthly payments, subsidizing mortgages, or distorting demand with tax incentives. But if homes are increasingly unaffordable in gold terms, even low-interest loans become a trap, not a solution. Policy implications. Shift focus from interest rate manipulation to real value stability. Recognize that inflation targeting may destroy housing access. Consider alternative benchmarks, like HTI, when drafting affordability metrics. If a home costs more than 1.5 gold bars consistently, it suggests a structural imbalance, either in monetary policy or land regulation. Governments must be honest about the trade-offs between asset price growth and generational access to shelter. For investors, real estate versus real money. Real estate investors often chase yield or appreciation, but the gold bar benchmark flips that logic by revealing when housing is overpriced relative to sound money. This opens the door to timing market rotations between gold and real estate, identifying undervalued jurisdictions where real value remains intact, protecting against currency devaluation masked by asset inflation. Gold and housing are both long-duration stores of value, but only one of them doesn't rot, degrade, or require maintenance. Pro tip: if your real estate portfolio has outpaced gold for a decade, it may be time to rotate. For individuals, saving in gold, not chasing the bubble. For the average person, this framework is liberating. Instead of asking, how many dollars do I need for a down payment? Ask, how many ounces of gold will it take to buy a home in this country 5 years from now? This changes the mindset from speculation to preservation. It also empowers savers in volatile economies. In Argentina, Turkey, or Lebanon, gold-backed savings may preserve home buying power better than local currency. In developed nations, gold helps measure whether homeownership is getting closer or structurally drifting away. A new compass for global citizens. In a world of mobile capital, international migration, and digital nomadism, the gold bar benchmark becomes a global navigation tool. Where is housing still priced in hard money terms? Which countries are financially stable enough to preserve real estate value? Where can you build a life without being forced into intergenerational debt? This isn't just economic analysis, it's a sovereignty filter. 8. Conclusion. What 100 ounces can still teach us. The world has changed. Currencies float, interest rates are managed. Housing is no longer just shelter. It's a financial instrument, a policy lever, and too often a speculative game. But gold has not changed. It still cannot be printed. It still requires labor to mine. It still stores time, energy, and trust in a way no fiat system can replicate. By using 100 ounces of gold, a single bar, as our unit of account, we cut through the fog. We reclaim truth from the distortions of central banking, debt manipulation, and inflationary denial. The gold bar benchmark tells us something powerful. When housing costs more than 1 bar, it may not be more valuable, just more financialized. When it costs less than 1 bar, it might not be cheap, it might be real. And when we compare nations, we see who has preserved real value and who has sacrificed truth for policy convenience. The Housing Truth Index gives us a compass. Not just for investment, but for sovereignty. Not just for price, but for integrity. Whether you're a policymaker, a homeowner, or a digital nomad, ask not what the price is in dollars. Ask what it is in ounces. Because the truth of a house is found in the weight it holds. Title: The Gold Bar Benchmark, Measuring the Real Cost of Homeownership Across Nations. Summary statement. This exposition introduces a cross-national framework that redefines housing affordability using gold as a universal unit of account. By calculating gold-to-house ratios, denominated in 100-ounce bars, and layering in long-term sovereign debt yields, we expose hidden volatility, inflation distortion, and structural imbalances in home financing. The result is a new lens for assessing real estate stability and the debt burden behind shelter across global economies.